the world watched in disbelief as former President Trump threw another curveball into the global trade system. His abrupt suspension of tariffs while sparing China has sent shockwaves through markets and economies worldwide. This unexpected move, effective April 9, 2025, slashed tariffs to a blanket 10% for most nations, but doubled down on China, raising tariffs to a staggering 125%. This decision, a stark departure from his previous stance, has left analysts scrambling to decipher its implications. The tariff suspension, presented as a 90-day reprieve, is far from a simple act of goodwill. It carries the unmistakable scent of a calculated gamble. By offering a temporary truce to most nations while simultaneously tightening the screws on China, Trump has created a high-stakes game of economic chicken. The world holds its breath, wondering if this is a path to resolution or a prelude to a full-blown trade war. The suspension, however, comes with notable exceptions. Canada and Mexico, partners in the United States-Mexico-Canada Agreement, are exempt from the additional 10% tariff. They remain subject to the existing 25% duty on goods falling outside the agreement's purview. This selective leniency underscores the strategic nature of Trump's maneuver, aiming to consolidate alliances while isolating perceived economic rivals. The initial market response to Trump's tariff twist was nothing short of explosive. US stock markets, as if injected with a shot of adrenaline, surged to record highs. The Dow Jones Industrial Average soared by an astonishing 7.8%, while the S&P 500 and Nasdaq followed suit with gains of 9.5% and 12% respectively. Retail giants like Walmart, Target and Nike, sensing a reprieve from the looming threat of higher prices, saw their stock values skyrocket. Across the Pacific, Asian markets, catching on to the wave of optimism, rallied with equal fervor. Japan's Nikkei index surged by 8%, while South Korea's Kospi wasn't far behind with a 5.5% jump. Even China's SSE Composite Index, despite the increased tariffs, managed a 1.6% gain, perhaps reflecting a glimmer of hope that a deal could still be salvaged. However, the exuberance in the stock market was tempered by a sense of caution in other sectors. US crude oil futures, a barometer of global economic health, jumped by over 4%, reaching $62.35 per barrel. This uptick, while signaling increased demand, also hinted at the inflationary pressures unleashed by the trade war. The bond market, on the other hand, reacted with uncertainty, with the yield on the 10-year US Treasury note dipping slightly to 4.4%, reflecting a flight to safety amidst the volatility. Trump's tariff tactics have been met with a chorus of condemnation and swift retaliation from major economies around the world. China, the primary target of Trump's trade aggression, reacted with defiance, labeling the tariff hike as economic bullying and vowing to defend its interests. Beijing swiftly retaliated by slapping 84% tariffs on a range of US imports, further escalating the trade war. The European Union, long a proponent of free trade, wasted no time in condemning Trump's protectionist policies. Brussels announced retaliatory tariffs of 25% on $23 billion worth of US goods, sending a clear message that the bloc would not be bullied. The EU's response, effective from April 15, 2025, targets a range of iconic American products, from Harley-Davidson motorcycles to Kentucky bourbon, adding fuel to the already raging trade war. South Korea, caught in the crossfire of the US-China trade war, urged both sides to return to the negotiating table. Japan, another key US ally in the region, welcomed the temporary suspension of tariffs but expressed concern over the continued levies on steel, aluminum and automobiles. Canada, while welcoming the pause in tariff hikes, announced its own retaliatory tariffs of 25% on US vehicles and auto parts. As the trade war escalates, economists warn of a looming global recession. Jamie Dimon, CEO of JP Morgan Chase, and Jan Hatzius, chief economist at Goldman Sachs, have both issued stark warnings, predicting a significant slowdown in economic growth, potentially tipping the world into a recession. The uncertainty surrounding trade policies, coupled with the inflationary pressures of tariffs, has created a climate of fear and uncertainty in the global market. Small businesses, the backbone of the US economy, are among the hardest hit. Reliant on Chinese imports for everything from raw materials to finished goods, these businesses are facing shrinking margins and mounting pressure to raise prices. The ripple effects are being felt across various sectors. Apple has resorted to airlifting iPhones from India to avoid tariffs, while Amazon has cancelled orders from China and other Asian countries. The impact is even trickling down to everyday consumer goods. Sneaker prices are expected to surge due to a 42% consumption tax on Asian imports. Even Christmas decorations are not immune, with US orders for festive trinkets from China grinding to a halt. The trade war's tendrils are reaching far and wide, squeezing businesses, disrupting supply chains, and threatening to dampen consumer spending.